Hello and welcome. This is Mary Magnuson, and I'd like to welcome you to today's webinar on broadband finance strategies. This is one in a series of monthly webinars Blandin Foundation offers for our Blandin broadband communities and open to anyone with an interest in using technology to improve community. Before we begin, I'll point to the chat box in the lower left corner of your screen. To interact with us at any time during today's webinar, you can simply type your question or comment in the chat box. And now let's get started. Again, my name is Mary Magnuson. I work here at Blandin Foundation, and I administer the Blandin Community Broadband Program. Joining me today is Bill Coleman of Community Technology Advisors, who I'm sure many of you know. Bill has been Blandin Foundation's primary broadband program consultant for a number of years. Bill will introduce our guest speakers today. They are Shannon Sweeney of David Drown Associates, Paul Donna of Robert W. Baird and Company, Nancy Hoffman of Chisago County HRA EDA, and Mark Erickson from the City of Winthrop. Take it away, Bill.
Thank you, Mary. Thank you, everyone, for joining us. This session on broadband finance, public sector financing, is really going to give some great examples of how these tools can be used and where they have been used. We've got 4 expert speakers, 2 from local communities that have made use of these tools, and then 2 finance specialists. And so I think it's going to be a good session. If you have any questions, feel free to use the chat box, and we'll get to those as we go. First up is Mark Erickson. You can see his handsome face there, and on the screen, Mark is the EDA director with the City of Winthrop, and has really been a leader on the RS Fiber project for Renville and Sibley counties, now in operation for, I think, entering its 2nd year, and doing great things there in south central Minnesota. Mark has been a national speaker at all kinds of conferences, the broadband communities and Fiber to the Home conference, and so he's an expert and well-regarded outside the state of Minnesota. Mark, tell us about RS Fiber.
Well, thanks, Bill, and the opportunity to talk to the group today. RS Fiber is a kind of a unique public-private partnership between 10 cities and 17 townships and a private cooperative, the RS Fiber Cooperative, that was created 3-4 years ago to enable this fiber project. It's about 1,000 square miles in its footprint. It has built fiber to the home in 6 communities and has connected those communities with fiber, and has 4 more towns to build out this year, the cities of Broughton and Stewart and Buffalo Lake and Fairfax. That's all part of a phase 1, and the second part of that phase 1 is we are providing 25 meg symmetrical wireless off of our fiber backbone to probably about 80 or 85% of the rural area in our footprint. Phase 2 of the project, which we hope will begin in a couple of years when the cash flow is right, we have plans to build fiber to the home, or excuse me, fiber to the farm. And that's a challenge. And you know, this whole project is a challenge in these smaller communities because it's a business and you have to make it cash flow. And the disadvantage that the current providers have is their business models just don't allow them to make that higher cost investment of fiber optics in their exchanges. So what we did is we offered through the joint powers board of these 10 cities and 17 townships, we offered a loan to the cooperative from the proceeds of a generally obligated tax abatement bond. In phase 1, the 10 cities sold a bond in the amount of just a little over $8 million and loaned it to the cooperative to help them start up their operations. So we think that's a good public-private partnership. We started with a kind of a traditional, at the time, revenue bond. It wasn't a good time in the economy, and the bond market didn't react well to our plans for a revenue bond, and that was stopped. through the great advice of Shannon and David Brown, we refocused our efforts, and Shannon came up with the idea of creating a partnership between the Joint Powers Board and the private cooperative, and selling the bond proceeds and loaning them to the cooperative as an economic development loan. We offer traditional internet off of this fiber network, anything from a gig symmetrical, and our lowest offering is 50 meg symmetrical, to cable TV services, phone services with all the attending features, as well as some farm and home security offerings. It's an active Ethernet project in the first phase, which means all of the subscribers have their own individual fiber connection back to the head end. So like on a copper network, whether it's DSL or cable today, at the end of school, on a snow day, the speeds will slow down. They do not on our fiber network because it's designed to give everybody the speeds that they have subscribed to. I don't know what else to tell you. I'd be happy to take any questions. It really is a recognition by the 10 city councils and the boards of the 17 townships that the providers just were unable to serve this area here. We asked them to provide service. They were unable to. They do a good job. We don't knock the providers at all. They were just unable to do it. So the great vision and the ability of the councils to lend these dollars and make this project move forward was really a critical element in all this. It also took a lot of great partners like Hiawatha Broadband and Phil Kaithon from Pro Growth Bank to make this work. But it really was a good collaborative public-private partnership that was also enabled by the Blandin Foundation.
Hey, Mark, could you talk a little bit more about the formation of the co-op and how that came about and who supported that and the path for that?
Sure, Bill. In about our third year, we started this in about 2009. It really took shape in 2010. We took a swing at really the Joint Powers Board hiring Hiawatha Broadband to be the operator of the system, and the Joint Powers Board would be the owner. The revenue bond didn't work out. One of the counties, Sibley County, backed out in a way that upset the rural patrons because they had suggested that we do a rural study and a rural build. That's what our feasibility study said we could do. When the county backed out and left the rural participants out, they decided they needed to form a cooperative to represent their interests. And as we moved into the new financial model, it was an obvious partnership between the efforts of the Joint Powers Board to lend money to a private entity. The cooperative was already there, so the Joint Powers Board turned all of the authority and ownership of the network over to the cooperative, and so far it has worked.
Good, thank you. Nancy Hoffman, Director of the Chisago County HRA and EDA. I've been lucky to work with Nancy on a number of projects through the years. Nancy has a master's degree from Mankato State University in the Urban Studies program. That's also where I got my degree. And I'm a Star City, and I helped Nancy with that many years ago. But as an economic developer, she has the traditional responsibilities on site selection, finance, loan packaging, industrial park development, business retention, and recruiting. Nancy's been a big part of the Chisago Lakes America's Best Community competition, which has been a great project. But Nancy's really done something for one of her communities, one of her townships that no one else in Minnesota has been able to do effectively, and that's to partner with CenturyLink. And so Nancy's going to talk about that project in Chisago County. Nancy?
Okay, thanks, Bill.
Yes, this project came to us from a company that was located in Sunrise Township. It's called Step Manufacturing. And the owner had been paying more for broadband than anything else that they paid for, including their labor. And they have over 40 employees, about 45 employees right now. And, you know, that should be their largest cost. And so they had contacted our county commissioner, who knew we were working with the Blandin Foundation on broadband. And so he sent them over to my office, and we brought in CenturyLink, since they were in a CenturyLink area. We brought in Diane Wells came to our office, as well as Bill Coleman in some of the early meetings. It started out as just talking about upgrading Step Manufacturing, but as time went on, it ended up being, let's do the neighborhood, and then all of a sudden it was the, hopefully the entire township. The Step Manufacturing brought in their IT guy, who happened to be a neighbor in Sunrise Township, and he really liked the idea of bringing fiber to everybody in the township. Of course, the whole township is not serviced by CenturyLink. Just to make it a little more complicated, you can see on this map that I have the light blue area is the part of the township that is serviced by CenturyLink, and the bottom east side is Frontier Communications. Frontier was planning to bring in DSL with their CAF II dollars, and we did try to contact them to see if they would also partner, but we didn't get anything going on that end. I think they were too far along in their plans and just kind of wanted to keep going. But we had a couple options with CenturyLink. We could either just use the Connect America funds, and they would upgrade to the 24 down, 3 up. Some people may only get 10-1 service, but that would be a whole lot better than what they have right now. Or we could try for the fiber. There's a number of home-based businesses in this area, as well as commuters who would love to telecommute. And so there was a strong support by the residents to move forward with the fiber to the home option. So we decided to submit a border-to-border grant application, and this is what the financing looked like. 45% of the project would be border-to-border grant, and then the remainder would be funded by CenturyLink with their CAF II dollars, and Sunrise Township would put in 25% of the project. There were 2 options for bonding that we considered, and one was a subordinated service district and the other was tax abatement. But the township really didn't want to, with a tax abatement, they basically would be charging the whole township for the service, and they really only wanted to charge the people that would benefit from it in the CenturyLink area. And so they liked the idea of the subordinated service district. They also liked the idea that this type of district needed 50% of the residents to sign a petition in order to move it forward. They really wanted to know everybody wanted it and not just a few neighbors that felt strong about it. So they liked that idea of the petition. Once the petition was signed, they brought in, and we found out we were eligible for the border-to-border grant. Then they were able to move forward with a public hearing to approve the bonds. But they did allow a 60-day, there's a 60-day window there where 25%, okay, if a petition were signed by 25% of the people in the area, they could potentially turn down this project, but it would take it to vote. The township had the option to either assess the homeowners by property values or by parcels, and just last Thursday they decided to go by parcel. They felt that each resident is getting the same service, no matter how valuable their property was. This might be very hard to see, but when we were looking at value, you could see that it's for a $250,000 home, it would be about $99, $100 a year. And so the residents were pretty happy with that. I mean, that's only $10 a month more. And they actually feel like they're really saving money because even though their CenturyLink bill would probably go up, they're getting great service, and so they can probably cancel their television. They can maybe have a different phone service using the internet, and by pulling all that together, they're really saving money. In fact, we're putting together a little piece that some of the neighbors are putting a little piece together stating all the savings that they have, versus this additional $100 a year that they'll pay for 10 years. Okay. So we did feel it was a good project for a border-to-border grant because it was basically shovel-ready. It was totally driven by the residents. In fact, if I were to do it again, I would strongly encourage the township to provide more assistance. They really stayed kind of hands-off and let the residents do it, but the residents had to go out to each home and get all these signatures. And I think the township could have helped out a little more by sending out a notice to the CenturyLink customers and letting them know that this is coming up, and if they're interested, to come in and sign a petition. It was kind of a long, grueling project for those residents. I think the partnership and financing was also a big part of it. The township's participation, CenturyLink's participation. So that was helpful. And then we requested less than 50% of the project from deed. So I guess that was our project, and it should be going in this summer. Actually, Step Manufacturing already has theirs in. They paid a little more and had part of the project done ahead of time, but they'll be going in this summer and hopefully done this fall for sure by the end of the year. So we're looking forward to having fiber to the home.
Nancy, any recommendations for working with CenturyLink?
You just kind of have to be patient. We had a real good working relationship. They put this package together. It changed. It was kind of morphed into what it was. They started with quite a bit larger number of residents. I'm not quite sure why that changed, but it was kind of a moving target for a while. But when it came down to it, they had some good numbers for us, and it made sense to the township.
Okay. And how many residents in that
part
of the township?
It was about 700,
okay.
Just under.
700 households or people?
700 households.
Or, of course, depending, I see Dana Keogh's on the line. That they have about 80 households, I think, in their township. So a little bit different. Thank you, Nancy.
Right. Sure.
The next speaker is Shannon Sweeney, and Shannon works for David Drown and Associates. For the last 16 years, he has worked for David Drown Associates as a financial advisor to Minnesota communities, townships, and counties. Shannon has had the opportunity to work on a wide variety of projects that include assembling financial packages and proposals for industrial parks, affordable housing, municipally owned essential function bonds for housing, creation of numerous tax increment districts, and so on. Recently, Shannon was involved in assembling funding for an economic development loan made by the RS Fiber Cooperative, which we had just heard about. And then he's also been advising the Southwest Minnesota Broadband Project centered out of Jackson. Shannon, thanks for joining us today.
Thanks, Bill. Wanted to touch on a few points that were probably made by Nancy, and we'll chat about just some of the common laws that of the project finance that have been used, by RS Fiber and others. Here's essentially 3 areas of Minnesota statute that I was going to talk about briefly. The first was tax abatement law, and under Minnesota statute 469, it provides for the use of tax, or essentially a levy of tax against benefited properties for the purpose of funding projects. And the definition of projects is fairly broad. And so we found this law to be flexible enough to do a wide variety of projects, including fiber projects. We've used it for airport projects. We've used it for acquisition of private commercial facilities. Really broad authority that's helped communities implement economic development goals. And cities, counties, and townships and school districts are eligible to use tax abatement. The public purpose requirements are that we must find that the benefits of the abatement exceed the costs of the taxes being abated, which again is a fairly general statement, and findings can be made to accomplish that. We must find that the abatement will increase or preserve the tax public facilities or infrastructure, redevelop or renew blighted areas, and provide access to services. That provision of access to services that is a key in identifying the need to use tax abatement to fund fiber projects. And the interesting part about abatement law is that can be applied in any number of ways. It could be applied for, directly funded projects. It could be used in the instance of RS Fiber as a means to provide an economic development loan. Private startup cooperative provides a fair amount of flexibility. The term of an abatement, and essentially it's the levy of tax that's being pledged as a repayment for bonds. The maximum is 15 to 20 years. The law states that says they don't care to participate. And so, it's pretty easy to contact the local school district and say, can you send us a letter saying you don't wish to participate, for an example, in our fiber project? And usually they're happy to say, yeah, we will send you the letter. And with that letter, we can extend the term to 20 years. A unit of government can essentially make an abatement pledge, and ultimately we should think about this as a tax levy pledge, because in many instances it's a levy that's spread over all of the taxpayers. But at the end of the day, pledge up to $200,000 per year, or 10% of its net tax capacity, whichever is greater. So for most, communities of, even 2,000 to 3,000 or less, lots of townships, those kinds of folks, the $200,000 per year limit on what they can essentially is the requirement. Well, that $200,000 per year needs to be applied to a principal payment on a bond issue. And so $200,000 over 20 years in principal payments will finance a pretty good chunk of money. And that's the type of authority, where you have multi-jurisdictional projects like the RS Fiber project, where you can leverage that capacity of multiple townships, multiple cities, etc., to borrow sufficient funds to make a good dent in the costs of a project and encouraged by other lenders. And so, that's precisely what they did in the instance of RS Fiber. I've seen examples of this in other counties, where counties are using their abatement authority to issue bonds for the purpose of making loans of bond proceeds to private companies to expand fiber networks. Ultimately, the intent is to never make a tax levy in many instances, and that the loan payments from the private entity will, pay off. I am aware that there was a $1 million grant down in Southwest Minnesota. I believe that was made by a county that simply used the abatement authority to provide a $1 million loan that is essentially forgiven. So it doesn't have to be lent or repaid, but ultimately that's the goal of most folks, so that they don't have to make a tax levy. Again, the abatement levy only needs to cover principal payments on the bond issue, so that gives us some additional ability to leverage when we're borrowing money. And proceeds, again, can be applied directly to project costs. So a unit of government can, install conduit, install fiber, or they can take the proceeds from abatement and loan that money to another service provider with or without a repayment agreement as an economic development loan. Abatement authority, before we jump into the special service district stuff, is, but in my estimation, provides the clearest path, the most straightforward approach for a local government to issue general obligation bonds to participate in a project. The next two authorities that we'll talk about, we just heard a project example on one of those, are interesting areas carved out in Minnesota statute that provide us the ability to issue those general obligation bonds. But at the end of the day, there's a few more procedural requirements. I'll call them, some would say hurdles, procedural requirements in order to move through that process. Special service districts under Minnesota Statute 428A allows cities to create special service districts that basically may not include a service ordinarily provided, or it's to enhance an existing service. Commercial, industrial, or public utilities can be subject to charges in this instance. What Nancy was talking about, I believe, was a subordinate service district. This is a special service district, a little bit different section of Minnesota statute. But to establish, you have to adopt an ordinance. You have to hold a public hearing with published and mailed notice. The property can appeal the charges to district court, much in the same manner as a special assessment for those folks that are familiar with special assessments levied by local units of government for street and utility reconstruction. The bonds are not subject to the net debt limit. So there's no election. Owners of 35% of the area or 35% of the recipient of 35 charges can veto the ordinance prior to the effective date. So, a third of the project area can decide we don't want the project, or we don't want the fees and charges, and eliminate the process. So, or disrupt the process, or basically stop the process, or halt progress on the project. So that's not something you find in abatement law, for example, and it's not something you find under most authorities that statute provides for cities, counties, and townships to fund projects. So it's a unique power granted to the resident, or the property owner, or the taxpayer. Subordinate service districts, a little bit different statute, 365A. Who can do subordinate service districts? Townships and counties. It has to be a defined area within the township. It cannot be the entire township, and the services to be provided are loosely defined as authorized governmental services. As Nancy mentioned, requires a petition from 50% of the property owners. There's a public hearing. Ultimately, the subordinate service district is approved by a resolution through a mailed notice. Bonds are not subject to the net debt limit. And if 25% of the property owners submit a petition prior to the effective date of the resolution, a referendum is required. So in this instance, if a quarter of the property owners decide that they're not on board with the proposed project, they can sign a petition, submit it to the governing board, and ultimately that would require a vote of all property owners or all voters within that jurisdiction, and it'd have to be approved by referendum. So again, more procedural requirements to implement this. With tax abatement authority, we're holding a public hearing. The unit of government involved is ultimately acting on their own portion of the property tax. They ultimately have the discretion on whether or not they're intending to participate in a project. There isn't these supplemental procedural requirements that require additional process time, etc. Generally, these projects take lots of time in and of themselves, and by complicating them with additional requirements to put the project financing in place can put the project in jeopardy. So we like abatement authority. We think it's been very useful in a number of projects, and if anybody has questions on abatement authority in general, I'm more than happy to answer those going forward. So thank you.
Thank you, Shannon. We have a question about townships and joint powers boards. So can townships then enter into joint powers agreements?
Yes. Townships can enter into joint powers agreements. When I was reading subordinate service law, I believe they can also work cooperatively on subordinate service districts.
Okay. And so I'm interested in that an area. So if a group of townships were going to try and do a broadband project across the entire township area of, let's say, 2 or 3 townships, they could not do a subordinate service district. Is that right?
No. Again, the subordinate service area can't be the entire township. So.
Okay. And so their option then is just the abatement?
That would be my understanding, Bill. That or a combination of financings that Paul will talk about.
Okay, good. Well, thank you, Shannon. Thank you very much.
Thank you.
And now we have Paul Donna, and Paul, I just saw an email from Mary saying that you wanted to go before Shannon, so I apologize for that. But,
we'll make it work.
Good. And so Paul Donna joined Baird in 2014 and leads their public finance operations in Minnesota. Based on his 25 years of investment banking and municipal advisory experience, Paul offers innovative debt management solutions and top-notch underwriting expertise to municipalities, counties, schools, utilities, special districts, states, and healthcare institutions across the Midwest. Paul's expertise is broad and includes serving as an underwriter, replacement agent for debt secured by general obligation, essential and alternative revenue supported financings, as well as lease purchase and a certificate of participation transactions. Paul, thanks for joining us today.
Thank you, Bill, and thanks for having me, everybody. What I'm going to basically touch on is a little bit about revenue bonds, a little bit about general obligation bonds, and a little bit about a hybrid between the two. Basically, as we've learned today, and some of us have learned by going through some of these projects, revenue bonds, the traditional way to fund these tasks have been to issue revenue bonds, whereby we are securing the debt service from the revenues of the project itself, and that just no longer is viable today. We're getting closer, but since the crash pretty much in 2008, revenue bonds for new enterprises such as these have been very difficult and very costly to get done, and have basically rendered them not viable. Basically, investors are not willing to take that risk of the project being successful. So that pretty much validates why you've seen these tax abatement bonds and special service district bonds being issued with the geo backing, because we just, quite frankly, do not have a market for them. So a couple ways in which we're getting these done is certainly the GO bonds, which I'll touch on. But if we don't have the ability, whether political support or whether it's a balance sheet issue, if we don't have the ability to put that GO or general obligation pledge behind these bonds, we have to get a little bit more creative and bring in some additional enhancements. And that means taking risk. And so in order to get these financed today, the community has to assume some sort of risk, something beyond just those revenues from the project being pledged. And as with anything, the key is to striking that balance that meets not only the community's objective, but also is enough type of risk to get the project up and going. So what type of enhancements am I talking about? Well, certainly you may be aware of what's called an annual appropriation, whereby the city or a county would pledge to annually appropriate revenues or meet the debt service on that bond or that loan. And what's key there is that the annual appropriation can claw back, so to speak, into any available revenue source of that city or county. And a lot of times that adds that additional security that the investors need, knowing that if the revenues of the project are not going to be sufficient in the future for some reason or another, that city or county has the legal ability to use other revenues to meet that debt service payment. And what the key is that the county's or city's name is on that financing. And the investors ask themselves, what's the likelihood of the city of XYZ not appropriating? Because if they don't appropriate, that would really ruin their credit rating, their name in the markets, and make it very difficult to get financing in the future. The city of Windham used this type of financing in the past, where they had an annual appropriation clause built into the financing, which was largely a revenue-backed financing, but that was the way to get it done in the public market. Another way that these have been getting done, and you probably are well aware, is to cross-collateralize them with other enterprise funds of a city in this case, using either the electric or water or sewer enterprises as additional collateral or security to make up any gap, to add that additional security and pledge behind the financing. That's been used a lot down south of our border in Iowa, with a lot of municipal utilities down there where they financed broadband and fiber that way. A third way, which I have not seen done yet, but it's certainly a viable option, is EDAs and HRAs, and I'm sure Nancy's well aware of this. They have a special benefits tax levy pursuant to Minnesota law, where there's a certain percentage of the market value of the entire county, in this case. The county can levy that as a special tax levy. And we're allowed to use that special tax levy and use it as a pledge to the debt service on the bonds. It's what is called a limited tax pledge, so it's not as secure as our general obligation pledge, which is an unlimited tax pledge. So it's in between. So another hybrid type method in order to enhance a revenue bond in order to get it marketed. So just to be clear, the difference, the pure revenue bond, where we've only got revenues from the project paying the debt service and pledge to the debt service, those are not viable. That's why we need these hybrid techniques to add additional security and get the investors comfortable and bring those interest rates down to a level that works within the project cash flow. Some additional credit enhancements that will likely be required or talked about, depending certainly on the project. We're always going to need a financial forecast. We're always going to need a feasibility report. We'll need to set up some type of debt service reserve fund, or in place of a reserve fund, we've put together what we call debt service reserve guarantees as well, whereby the city or county will guarantee to replenish a reserve if it's ever tapped. And then there's coverage requirements or excess revenues available for debt service, a calculation ratio that you need to at least have a minimum of 1.10%, where we've got a 10% cushion, and it can go as high as 1.25 sometimes. It all depends on what the underlying or underpinning additional enhancement is, which will drive that ratio range going forward. Shannon and Nancy had talked about the tax abatement bond and the special service district bonds, and those are general obligation bonds. So those are at the other end of the spectrum, whereby they're the most secure because of that unlimited pledge, but they're most secure because our city or county has the greatest exposure. They're at the greatest risk for making sure that debt service gets paid. And there's a certain number of obstacles, as you've read through, that we need to jump through to get those bonds issued. And that's why it's important to have a good team helping you through that process. And like I said, Nancy and Shannon touched on the tax abatement bonds, special service district bonds, and I suppose you could go to referendum on the Minnesota law to issue these types of bonds for this type of project. And lastly, I suppose a financing discussion is not complete without some graphs on interest rates, right? So what I'm trying to illustrate here for everyone is just kind of the traditional credit spread, and not to get too far into the weeds and using our jargon, but our industry uses what's called a AAA MMD, which is an industry basically standard of interest rates over the country. And then depending on the type of credit rating, how secure that is, there's a spread, there's a credit spread to that index. And if you look 10 years, right here, you can see here's where the crash was, and you can see this credit spread. This is what would be a very low rated credit, and this would be a very high rated credit. You can see that difference back then was almost 2.5%. That's on top of the nominal interest rate that the industry average would be. And you can see where today we've narrowed that spread greatly. So the point here being, the more secure, obviously, we can tailor the finance plan for the investor, that the lower the credit spread will be, and certainly enhance that cash flow of that project. But again, you need to balance that risk reward for how much risk the city or county is willing to take in return for that lowest interest rate. So I hope I answered some questions and provided some insight into the different avenues we've got beyond the general obligation bonds, and what to look for when putting that together.
Good, thank you. Paul and Shannon, I'm not sure who wants to answer this, maybe both. Janet lives up in a township up north of Duluth, and trying to figure out how, their financing tools, what might be the best ones they've worked with St. Louis County some, but not yet action. So if they're trying to do 3 or 4 townships, if the county was a financing vehicle, would that be a positive thing? And what tools could they use at the county?
I can start. The county would likely have a better credit rating than both of than the underlying townships, and so ultimately, if a unit of government was providing credit enhancement or a general obligation pledge or some form of pledge for repayment of the bonds, the county's pledge would be the strongest, which would result in the lowest interest rate. Recognizing the politics of asking a county to borrow money on behalf of a couple of its townships, particularly a large county, it may be that the townships have to work together. What I found is that townships typically have very low debt outstanding, which is good in the eyes of bond investors. They typically have a fairly significant tax base. Even though much of it's land, it's still a significant tax base that they can draw from. And under abatement law, each one likely has the ability to borrow, a couple of $1 million. And so if you combined 2 or 3 townships together, you probably have sufficient capital to assemble a pretty significant project.
Okay. And then is there any opportunity for a county to kind of provide a backup guarantee to township financing that would help them improve their bonds?
Oh, as Paul mentioned, through HRA or EDA pledges, there's probably some ability for the county to make some sort of additional pledge. Maybe he's seen something even more straightforward than that, but certainly there's a role the county could play. Again, it's probably more a political question whether they're willing to do that for 2 or 3 townships when they have many.
Okay, thank you. I have a question about the ownership of the network. So in RS Fiber's case, that's a brand new cooperative. In Chisago County, that's just essentially a grant to a large company, that reliable operator. The ownership of the network have a lot to do with the credit and the financing tools.
I think it helps with the feasibility and the analysis of whether or not we think the project can work. Even a startup RS Fiber cooperative had Hiawatha Broadband Communications with years of experience as an operator, which I think put people at ease with having somebody with lots of experience involved.
Mm-hmm.
Is it required? Ultimately, if you're issuing a general obligation, the investors are making that investment based on that entity's ability to levy a tax against all of its taxpayers. And so if they have ample ability to borrow the money and pay it back regardless of whether the project is successful, and they're making a general obligation pledge, that operator probably isn't going to mean as much. It should still mean as much in analyzing the project feasibility, but as far as having an impact on interest rate, it probably won't have a great impact.
Okay, thank you. Mark or Nancy, do you guys have any additional comments on your projects and kind of the challenges of moving through the financing?
I think for us, some of the challenges that we saw was this is really new for townships. They're not used to bonding in the first place, let alone doing much else than roads. and so that was probably our biggest challenge, was bringing the township board along and getting them to understand what it would take. They were kind of scared of bonding for so much money when they don't normally do that.
And that Shannon's a scary guy too.
Yes, right.
Yeah, I think I would echo what
think-
Nancy said. Of course, our townships haven't actually bonded yet. That's all part of the phase 2. But it's an education process, and not only with the cities, because you know a geotax abatement bond in small towns isn't used that much, and especially for a fiber optic network. But the townships were not suspicious; they were just cautious. So if you're sincere and if you bring in great
Right.
people to help explain things like Shannon and like Paul, then I think you're in good shape.
Okay, thank you.
And,
Paul
and
or
we had,
Shannon?
you know, because it was oh, I'm
Go
sorry.
ahead, Nancy.
Because we were working with CenturyLink, a lot of people didn't like the idea of the bond money going to CenturyLink to help them build their business, basically. It was interesting that more negative comments came from outside of Sunrise. You know, everybody in Sunrise wanted this, and this is how we had to get it done. But there were some negative comments and rumors floating around, so we really kind of had to dispel some of those as well, and let them know that this is what we have to do today to get that kind of thing done. So.
Mm-hmm. Okay. Paul, any closing comments?
No.
Or Shannon?
No, I'm sorry, I didn't hear you there, Bill. But as far as closing comments, no, I think everyone did a great job of just kind of outlining what's available out there. But Mark indicated that it takes a lot of thought and a good team to help navigate through these options. Because certainly it's not one fits all. That's for sure. And so it's a process of evaluation and some fits and starts sometimes. But we're getting closer. It's still evolving, but we're getting closer to this being more of a typical type financing.
Thank you. Paul, or maybe you could explain a little bit about the difference between a company like Baird and a company like David Drown Associates and the role of those advisors.
Oh, sure. Well, maybe it's best as an example with the RS Fiber project. Worked as they were the advisor on the finance. Well, certainly helped with a lot, but for the most part, their role was as financial advisor in helping put together the project financing. Baird's role and what I serve as is basically as underwriter. So we basically purchase the debt, but work on the finance team together, but in a very separate role. Underwriter and financial advisor each serve a necessary function in getting the financing put together.
Okay, good. Thank you.
Is that helpful?
It does. It does. And Shannon, do you have anything to add to that?
Nicer car.
That's funny. A nicer car.
That's the difference between a financial advisor and an underwriter. So.
Yeah, there we go. Well, great. Thank you very much. Very informative. I learned a lot about these tools and feel a little better prepared to talk about them now with communities. Mary, do you want to close this out?
I sure will. Thanks again to Bill, Nancy, Mark, Paul, and Shannon for joining us on the webinar today. For our next webinar, we're hoping to do a live broadcast from the National Digital Inclusion Alliance Conference in St. Paul on May 16th. Watch for more information on that soon. Thanks everyone for attending today's webinar and have a great rest of your day.